I thought I'd just talk a little bit about the importance of financial planning. A lot of people consider themselves to be experts when it comes to investing, or they think they've got a good take on investments and what happens in investment markets. And I think it's important to recognize that a financial plan is more than just having good investments. The starting point for most financial advisors will be to look at the balance that people have between investments and between risk portfolios, things such as life insurance, disability, dread disease, and income protection. What we find is that a lot of people plan for disaster or death, but they don't think about planning for life. So it's important to think about retirement and what you're going to do, assuming you do have a long and fruitful retirement. An interesting side on that as well is that what we have nowadays, what we call a sandwich generation, people who are looking after both their children as well as their parents. And along with longevity, there are some downsides, and that's obviously one of them. So in addition to having to plan for your own future to the age of 80 or 90, you need to think about your parents' future to the age of 80 or 90. And many of them didn't plan on that in the days when they were investing and planning for retirement. There are also a whole lot of challenges that come with the fact that nowadays people don't have lifelong employment anymore. They don't join one firm and stay there for 40 years. So each time they leave a job, do they preserve correctly, and do they manage those preservation funds? We have a lot of clients that come to us with 12 or 14 preservation funds, retirement annuities, all taken out with good intentions, but no management along the way. Some people 10, 15 years ago were investing as much as they could offshore. Those have been very disappointing investments over the last 10 years. So active management of those portfolios is critical. Just going back to the balance between planning for life and planning for death, what's also been interesting with increased competition in the risk space from the various life insurers, you're now often able to replace insurance policies with much lower premium products that have better benefits. So speaking to an expert and getting someone who has an idea of what they're doing there is very important. We know that financial services is going through a tremendous amount of regulation at the moment. That's a very good thing. It chases away the people who don't do their jobs very well. And the importance of dealing with a certified financial planner, people who have the necessary qualifications and who treat this like a profession, is absolutely critical. Lots of people then worry about the fees. What is this all going to cost me? I always say what you've got to look at is what value are you going to receive. Because if you're receiving a certain value for what you're paying for, then usually the fees pale into insignificance. So rather than looking at what it's going to cost you, maybe the approach should be looking at what it's going to save you. If you're able to save income tax along the way, if you're able to save estate duty through a careful plan, then the fees usually are well worth paying. I think the other part of it is that trust is absolutely critical. And when it comes to paying fees, it's important to feel comfortable asking what it is you're paying for, exactly what it is that you are going to be paying, and then you can determine whether you think the fee is reasonable given the benefits you're expecting to receive. And most financial planners, especially qualified ones, will insist on showing you all of the fees. If you're not seeing fees, or you see one provider whose fees are substantially lower than another provider, it's also important to ask whether those are all the fees, and maybe ask for that in writing as well, because if you're not seeing all the fees, I think it's difficult to then be able to trust the person who's giving you advice. Just on the idea of risk, what's also interesting is that many people view equities as being very risky, share portfolios, unit trusts that invest in shares. And they consider them to be risky without taking into account any of the mitigating factors. Now, a major mitigating factor when it comes to investing in shares is going to be the period of time that you're investing for. Because if you've got a time horizon that is longer than an investment cycle, and we've noticed nowadays investment cycles are actually getting shorter and shorter as there's more and more information flow, suddenly it's not a 7 or 10 year cycle, it's sometimes even a 5-year cycle. But if you're investing for 5 years or longer, having equity in your portfolio is absolutely critical, because it's the only way that your portfolio will actually keep pace with or outstrip inflation. So there has to be share exposure in a portfolio if you're hoping for growth in real terms. In other words, to be able to actually buy things with the money that or buy more in future with the money that you have. Portfolios do need to change with age, but age is not going to be the only factor. that will determine whether the portfolio needs to change. There are some people who have provided sufficiently for their own retirements, and their focus is now on providing a legacy to their children or their grandchildren. And when it comes to legacy provision, it's no good looking at the age of the investor. It's then important to look at the age of the beneficiaries who are being provided for, because that's actually the investment time horizon. So you can't make a decision about equity exposure based purely on age. What is also quite scary is some of these lifestyle products which say that because you're a certain age or because you have a certain amount of time available until retirement, your risk profile or your equity exposure should be dictated purely by that factor. It's not the only factor, which once again is why it's worth having a financial planner. Good financial planners also will ask a bit about your will. Many people have got wills. Some of them don't know where the original is. Not everyone has checked to make sure that the will is signed correctly, that the beneficiaries, executors, etc. are not actually signatories to that will. It's important to know who your executor is, and nowadays more and more focus on what that executor may charge you in fees, because there are ways of actually being able to negotiate that after death in terms of the correct drafting of your will up front. So there are all sorts of factors that should be taken into account when you're reviewing your will, and it's an exercise that should be done on a fairly regular basis. Many people have left bequests to people that are important to them, and those bequests have not necessarily been updated with time. The other big change we've had recently is the R3.5 million exemption, which now can be accumulated and rolled over to the surviving spouse, and that also has an impact for estate planning. So once again, a good advisor will insist on actually making sure that the will is reviewed on a regular basis. The other important thing when it comes to planning for death is to look at where all your papers are. Will it be easy for the people left behind to actually deal with the mess that you've currently created? So sometimes cleaning things up, and you don't have to be ready to die to do this. It's the way you should actually start out in your financial plan, knowing where everything is. Do the people that you care about know what the passwords are to your computer? Can they access the information that you've saved so carefully, or the photographs that you've built up and saved over a period of time? These are all the types of things that need to be thought about if you want to make sure that you leave the people you love in the least possible predicament.